What's up, guys? In today's video, we're going to talk about Theranos, Elizabeth Holmes, kind of the relationship between investors and entrepreneurs and how venture capitalists think about investing, kind of some mispractices that happened when investing in Theranos. So quick recap, if you haven't heard about Theranos, it's all over the news, but Elizabeth Holmes was a Stanford dropout. Classic, right? But at 19 years old, she decided she didn't need to keep going to school, and she started this healthcare technology company. The whole thesis that, the lengthy process of drawing blood and getting it sent off to a lab and these lengthy just testing processes is no more. She claimed that you could, off just a drop of blood, just a single finger prick of blood, her machine and technology could do about 200 test results and have results back in minutes. So kind of this, revolutionary technology. She started it, in 2003, and this is like right, during this, massive tech boom. So there's all these investors in Silicon Valley, the Facebooks, the Amazons that are just raising, millions and having valuations in the billions. It was a, great time for entrepreneurs and investors. And Elizabeth, we're going to talk about some of the things that she did right and some of the things she did wrong. Basically, she developed this software. She got some seed money from friends and family. She started putting the company together, and, she quickly started not caring as much about the technology and started investing more in appearances. She was criticized because as she started and going out and raising money, her voice got deeper, and she started wearing black like Steve Jobs. And, she just started to be more assertive. And, she thought it was a better technique for going out and raising money. Obviously, all startups have these crazy forecasts, and that's fine in venture capital. It's fine to have these assumptions and to say, yeah, we anticipate this massive total addressable market of X gazillion, and we hope to be there in 3 years or whatever. And that's standard startup talk. Where Elizabeth went wrong is not about the forecast. That's totally fine, but she started misrepresenting her current traction. So she started lying to her current investors or potential investors about where she was at and what the company had done, how much revenue they had generated. That's where she started kind of deviating from the traditional course, because in the beginning, I had a lot of empathy. I'm like, this girl's just kind of trying to build this company. Like, what's wrong with that? But as you dig more into the story, then you learn more about this. So obviously, there's a bunch of videos about it. There's a book called Bad Blood. There's actually a recent Hulu series that came out called The Dropout, all of which that kind of cover these. I'd recommend all of them. They're all great. But let's dig a little deeper here. Let's talk about this relationship. So something that Elizabeth did is she targeted not venture capitalists. She targeted, in her first couple raises, some people call it old money. Some people call it dumb money. But she targeted these kind of wealthy, old investors that, had missed out on kind of the boom, the dot-com boom, really played on the emotions to get them allocated. She went after these single family offices or just high net worths that had, come and do a lot of money. And the reason being is, a venture capital firm is going to do serious due diligence on any sort of deal. They're not going to make any massive allocations. I mean, maybe a seed round, but this is like when she was raising a Series A. They're not going to make any large investments without doing some serious due diligence on the company. And family offices are sometimes known to not be as scrutinous as VCs for angel. If they like the entrepreneur, they like the investor, or you just, the family likes you, you're a family friend, you can raise some more money. So she went out, she built a stalwart board of advisors, guys like Jim Mattis, Henry Kissinger, George Shultz, Robert Murdoch, Tim Draper, Larry Ellison. She got all these phenomenal names on board and behind her. And once you get one, it's a lot easier to get another. Just like for you guys that are raising funds, that first investor, it's that immediate stamp of approval, right? For anyone else you go to, yeah, this other person's already on board. It's like this reassurance, this almost referral that, hey, this is a good deal because so-and-so invested in it. So in venture, there gets to be this a lot of FOMO about missing out on opportunities. So sometimes rounds will, be subscribed really quickly without a ton of due diligence just because people want to get in. So Elizabeth did a really good job at playing those cards. She kind of batted investors against each other. She batted, potential contract, companies against each other, like contracts. But she really just played this game. And it's okay to do that, but you can't lie about your current traction. You can't be deceptive about your revenues or, at the stage at which some of these contracts are developed. So, like in 2013, she went out to, Walgreens. She landed this massive contract with Walgreens to start testing their facilities. And Walgreens didn't even look at Theranos. They basically just said, yeah, well, sorry, we already have a contract with CVS and Safeway, so too bad. We don't want to work with you. And then these offers came flying in. Always important to do your due diligence in, the venture marketplace. So another thing to be thinking about in this deal is one of my mentors once told me that rational deals provide rational returns, and irrational deals can provide irrational, unrealistic returns. So some people love, going after these kind of crazy, investment opportunities, but it's just part of the game, part of the risk. So, and another thing that made this deal so bad, right? Or what was so wrong about this is, this technology was impacting human lives very legitimately, and she didn't disclose that. They would go out and, when they signed that Walgreens contract, people would take these tests that made decisions about, what medication to take. All medication has side effects, right? They all do. So, people are getting misdiagnosed for diabetes or all these various illnesses that they may or may not have, all these false positives. So it's a very sensitive, arena to be playing in. She lied about the FDA's approval and, just was very manipulative and deceptive on all fronts. So, I have a friend who's, starting a tech company. They recently raised several $1 million in funding. And it's honestly kind of a similar scenario where their product isn't complete. And they collect this data for companies, and it's right 80% of the time. Except the thing is they disclose that to their investors and to their clients that purchase. They're like, look, we're still a startup, we're still growing. There's kind of this 20% chance that the data is faulty. Data for an e-commerce business is a little different than human lives deciding, looking at severe terminal illnesses. It was just kind of this bad mix of, the market they were in. She just went way over her head and manipulating and being deceitful to investors. I hope you guys learned something from this video. And just so you know, Elizabeth Holmes isn't the only one that this happened to. This is, starting to happen in different elements. Newman at WeWork, obviously not the same caliber of violation, but, pretty flagrantly deceptive, and the way he went out and pitched his company and got investors on board. So you're starting to see more and more of these. So all those VC funds out there, just be careful about the allocations you're making and investments, and always do your due diligence. So hope you guys have a good one.